The capitalist circuit does not end when the business earns more money. Yesterday's M prime becomes today's M. The expanded money is reinvested into a larger round of production with the expectation of another expansion. Capital does not simply seek profit once. It must accumulate. Welcome to democratic economy, where we follow the structure of the system to identify the underlying mechanisms of inequality. Why can a successful company not simply remain the same size? Because competitors continue moving. A company that keeps its present tools, methods, prices, and market share faces competitors that reinvest, automate, advertise, merge, and expand. Even maintaining the same position requires growth. If you're not growing while your competitors are, your relative position is shrinking. That is the meaning of grow or die. From the perspective of one company, productivity and labor reduction can appear rational. A machine lowers costs. Fewer workers are needed. Prices can be reduced. Market share can increase. Profit rises. But workers are not only production costs. They are also the consuming class. The workers' circuit is CMC. Labor power becomes wages, and wages purchase commodities. When companies reduce employment or suppress wages, they reduce the money available to complete millions of worker circuits. The same action that helps one company move from M to M prime weakens the ability of society to purchase C prime. Lower prices do not automatically solve the problem. If productivity cuts a product's price in half, but also cuts the total wages paid to workers in half, the consuming class does not suddenly buy twice as much. It may have exactly the same, or even less, purchasing power. The money captured as profit becomes concentrated among owners and investors. They can consume more than an average worker, but they cannot personally replace the consumption of thousands or millions of workers. There are limits to how many refrigerators, meals, houses, and pairs of shoes one person can use. The excess money seeks financial returns instead. It flows into stocks, real estate, debt instruments, and other assets. This flow causes prices to rise far above the labor value associated with their productive foundation. It is dependent upon the use value of those assets to keep those prices buoyant. For a time, debt can maintain consumption. Workers whose wages have not kept pace can borrow to purchase housing, education, healthcare, vehicles, and ordinary necessities. This delays the contradiction. Commodities continue selling, and capital continues realizing M prime. But debt is a claim on future income, on future labor. If wages remain weak while debt expands, future worker income is already committed before it is earned. The separation grows between market prices, financial claims, and the labor value available to support them. The greater the separation, the more speculative or exploitative the use value becomes. Housing prices may depend on perpetual scarcity. Medical prices may depend on patients being unable to refuse treatment. Asset prices may depend on future buyers accepting still higher prices. Corporate valuations may depend on profits produced through continuing wage suppression and market expansion. Every support has a limit. Eventually, some part of the circuit fails. Workers cannot increase consumption. Borrowers miss payments. Inventories grow, expected profits fall. Investors withdraw money. Companies cut additional workers in an effort to protect profit, which removes still more purchasing power. Price begins moving back toward the productive conditions underneath it. A small separation can produce an ordinary correction. A large separation accumulated across housing, finance, production, and wages can produce a violent correction, a crisis. The crisis appears sudden because the price collapse is visible. The structural separation that prepared it may have developed for years. This is why crisis cannot be explained only by greedy individuals, bad executives, irrational consumers, or one failed regulation. Those factors can influence when and where the break occurs. The deeper mechanism comes from the relationship between the two class circuits. Capital must continually expand M into M prime. That expansion depends on extracting surplus value from labor. Yet labor depends on wages to purchase the commodities through which profit is realized. The system increases profit by reducing the share going to the very class needed to sustain mass consumption. Government intervention may restore confidence, support demand, rescue financial institutions, or prevent social collapse. But stabilization does not automatically remove the underlying incentive to begin the cycle again. We began with an ordinary commodity. By following its nature, labor, use, price, ownership, production, and exchange, we arrived at class and crisis. That is the value of structural analysis. It shows how outcomes that appear accidental can emerge repeatedly from ordinary decisions made under the same rules. The next video is a complete review. We will rebuild the entire argument from commodity to crisis in one continuous sequence and test whether every step follows from the one before it.